Ellen kept the closing statement from 1990 in a folder in the hall cupboard. 1 page, 2 signatures, and the price they paid for the house, $95,500. 34 years later, she signed the house over to her 2 children. A title office, a Tuesday morning, 11 minutes. Those 11 minutes cost her children $60,262. Nobody in that room did anything wrong. The clerk was polite, the notary stamped the page. Her son drove her home afterward, and they had lunch. Ellen felt lighter than she had in months, because she believed she had just spared her children the one thing everybody had warned her about: probate. She was right about probate. She had solved it. What she did not know is that the same signature handed the IRS a number from 1990. It told the IRS to use that one instead of today's. Her children did not find out for 2 years. They found out at a closing table of their own. The accountant sitting across from them was reading the same 1 page Ellen had kept in the hall cupboard. So what was on that page? And why does a number from 1990 still decide what a family pays in 2026? Here is what that page decides. When Ellen bought in 1990, she paid $95,500. That figure is called her basis. Think of basis as the receipt the IRS keeps. When the house is eventually sold, the tax is not calculated on the sale price. It is calculated on the sale price minus the receipt. Ellen's house is worth $440,300 today. That is the national median for an existing single-family home in July 2026. Now do the subtraction out loud. $440,300 minus $95,500. The gain is $344,800. Her daughter sold it and owed capital gains tax on that number. 15% of $344,800 is $51,720. Then the net investment income tax added 3.8% on the part of her income above $200,000. That is another $8,542. Total tax, $60,262. If Ellen had changed nothing and the house had simply passed to her children when she died, the tax would have been 0, not reduced, 0. Same house, same children, same sale price, 1 signature apart. I want to be careful with that number. $60,262 is the tax. It is not the gain. Nobody is losing $344,800 here. They are losing $60,262, and that is bad enough without inflating it. There are 4 ordinary ways a house passes from a parent to a child in this country. 3 of them protect that receipt. 1 of them destroys it. And the one that destroys it is the one that feels most like love. I am going to show you all 4 and exactly what to say to set the right one up. If this is useful, a like helps the next family find it. 2 rules do all the work here, and they sit about a page apart in the tax code. The first is Section 1014. When someone dies, the basis of their property resets to what it is worth on the date of death. Lawyers call it the step-up in basis. Ellen's receipt would have been thrown away and replaced with a new one reading $440,300. That is the whole benefit. Sell the house the week after the funeral, and the gain is nothing, because the sale price and the receipt are the same number. The second rule is Section 1015. When someone gives property away while they are alive, the basis goes with it, carryover basis. The receipt does not get replaced. It changes hands. So the child does not inherit the house. The child inherits the 1990 price. Now here is the part nobody warns Ellen about, and it is the reason this keeps happening. Giving your house to your children is not a taxable event. There is no gift tax bill. Ellen filed 1 form and owed nothing, and everything she was told that day was true. That is exactly why nobody warns her. The title company is paid to transfer the deed correctly, and it did. The notary confirms identity. Nobody in that room has any duty to raise a rule that will not matter for years, not to a person who is not their client, not about a house they will never see again. The silence is not a conspiracy, it is a job description. In a family that already has an estate attorney, this conversation happens before the deed is ever drawn. Nobody in that family is smarter than Ellen. They simply had somebody in the room whose job covered the next 6 years. There is one more piece, and it is the one that surprises families most. Ellen could have sold that house herself and paid almost nothing. Section 121 lets a homeowner exclude $250,000 of gain on a main home. For a married couple, it is $500,000. The condition is that they owned it and lived in it for 2 of the last 5 years. Ellen qualified. Her daughter did not. She never lived there. That exclusion is not a family benefit. It belongs to the person who actually lived in the house, and it does not travel with the deed. So the daughter got the 1990 receipt and none of the protection that made it survivable. Which raises the obvious question. The paperwork was right. The tax was 0 at the time. Everyone in the room did their job. So when exactly did this become a mistake? It became a mistake on a Thursday this spring in an office in Columbus. Ellen's daughter Ruth had come to close on the sale of her mother's house. Ruth is 58. She had a number in her head because she had looked up what houses on that street were selling for. She had quietly promised herself that her share would finish the last of her own mortgage. The accountant asked one question: "What did your mother pay for the house?" Ruth did not know. She said she thought it was in a folder somewhere. It was. It was the same single page Ellen had kept in the hall cupboard for 36 years. Ruth had carried it in a tote bag with the death certificate. $95,500. The accountant did the subtraction on the back of a form. Ruth watched a number appear that she had never once considered. Then she asked the question every family asks in that chair. Would it have been different if she had just left it in her name? Yes, by $60,262. Ellen had been dead 9 months. There was nothing left to fix and nobody to be angry at. Her mother had signed that deed at 74 so that Ruth would never have to deal with courts and delay. And she had succeeded. Ruth never saw the inside of a probate court. That part worked exactly as promised. So let me give you what Ellen was never given. 4 ways a house moves from a parent to a child, and the words to use. Number 1, and it is free, do nothing. If the house is in your parents' name when they die, Section 1014 applies automatically. No form, no filing, no fee, no attorney. The receipt resets on its own. Doing nothing is not neglect here. Doing nothing is the plan, and it is the single most valuable thing on this list. Number 2, a transfer on death deed, sometimes called a beneficiary deed. This is the one that solves Ellen's actual problem. The parent stays the owner for their whole life. Nothing changes, nothing is given away, and the receipt stays intact. On death, the house passes straight to the named person without going through probate at all. Here is what to say. Call your county recorder's office and ask, does this state allow a transfer on death deed or a beneficiary deed for real property? If the answer is yes, ask what their recording fee is. In most counties it is under $100, and many recorders publish the form itself for free. Ellen wanted probate avoidance. This is probate avoidance. It costs a recording fee, and it keeps the $60,262. An attorney sets this up in one appointment and does not think twice about it. You can do the same thing with a phone call and a form. Number 3, a revocable living trust. The parent moves the house into a trust they control and can change at any time. Because they still control it, the tax code still treats them as the owner, so the step-up survives. Probate is avoided as well. This costs more than a deed. It makes sense when there is more than a house to organize or property in more than one state. Ellen had a house and a savings account. A deed would have been enough for her. Ask an elder law attorney this specifically. Will the house get a full step-up in basis under Section 1014 if it is held in this trust when I die? Ask them to say yes in writing. Number 4, and this one is only available in 5 states, Florida, Michigan, Texas, Vermont, and West Virginia. An enhanced life estate deed, usually called a ladybird deed. The parent keeps the right to live in the house, sell it, or mortgage it, and keeps the power to undo the whole thing. Because that control is retained, the house comes back into the estate at death and the basis resets. Outside those 5 states, a traditional life estate deed does preserve the step-up, but it hands away the remainder interest today, and that starts a Medicaid clock. That is a real trade, and you should know you are making it. So, do nothing. A transfer on death deed, a living trust, or a ladybird deed in those 5 states. All 4 keep the receipt. Only an outright transfer while your parent is alive throws it away. Now the honest part. 3 things make this messier than I have made it sound. First, and this is the one that catches careful families, there is a Medicaid exception that lets a parent transfer the house to an adult child with no penalty at all. It applies if that child lived in the home for at least 2 years. They must also have provided the care that kept the parent out of a nursing home. It is real, and it is in the statute. Ellen's son had lived with her for 3 years. That family very nearly took this route, but it is still an outright transfer while the parent is alive. So Section 1015 applies. The child takes the 1990 receipt and gets no Section 121 exclusion. A family that uses that exception to safely move the house has done the exact thing this video is about. The Medicaid problem is solved. The tax problem is created. I have not found a single source that puts those 2 sentences on the same page. That is my own reading of the 2 rules, not a quote, so take it to an attorney and ask. A family with an advisor hears both halves of that in the same meeting. Most families hear one half, from whoever happened to be in the room that day. Second, Medicaid and Medicare are not the same thing. Medicare is the health insurance your parent paid into their whole working life. Medicaid is a means-tested benefit that pays for long-term care. Medicaid is the one that looks backward at transfers. Federal law sets that look back at 60 months. What differs is the state. California currently runs 30 months, phasing in through July 2028. A transfer penalized in Ohio may not be penalized in California. One more reason to ask someone who knows your state's rules, not a national average. Third, my numbers are illustrative. Ellen's $95,500 is the 1990 national median. A real basis is the purchase price plus every capital improvement. The roof and the new furnace raise it and lower the tax. Find the actual closing statement first. And one thing you can stop worrying about. Federal estate tax starts at $15 million per person in 2026. That is not your family's problem. So here is the whole thing, in the order I would do it. 1. Find the closing statement from when your parents bought the house. Not the deed, the page with the purchase price on it. 2. If probate is the worry, ask the county recorder about a transfer on death deed before anyone signs anything else. 3. If there is more than a house involved, ask an elder law attorney the exact question. Will this house get a full step up in basis under Section 1014? 4. If your parents already put your name on the deed, do not panic. Do not undo it in a hurry either, because unwinding it has its own consequences. Take the recording date to an attorney and ask what is still available. And here is your one thing for tonight. Text whichever sibling is most likely to know and ask if anyone can find what mom and dad paid for the house. That is it. One question. You are not making a decision, you are finding the number that every decision after this depends on. I am not a lawyer, and this is not legal advice for your situation. It is the mechanism so that when you sit down with someone licensed in your state, you already know which question to ask. And here is the part I keep coming back to. Probate is the cost every family gets warned about. It has a name, it has horror stories, and everybody has heard one. The step up in basis has no name that anybody actually uses at a kitchen table. So families spend years defending against the cost they can see and quietly hand over the one they cannot. Ellen was not careless. She was well informed about exactly one of the 2 things that were going to happen to her house. If this was useful, please like it and subscribe. It is genuinely how these reach the families who need them. Ellen did a kind thing on a Tuesday morning. She just did it with the wrong piece of paper. Go and find yours.